All right, what's going on, everybody? This is James Tenison with Tenison Financial Group, here to give you guys some news that you can use. We are going to give you today 5 common questions that people have in regards to insurance. Right now, we have Jarvis Christian College very own Mr. Ashanti Wade. He is a financial advisor with over 10 years experience. He's the guru in the game, and he is also my business partner. Mr. Ashanti,
yes, sir.
Got anything to say?
Well, I'm glad to be here, and it's exciting to sit down and break this all down for people because we get, when it comes to life insurance, we get these questions all the time, and there's so much confusion with it, and people just want clarity. So especially in a time like this right now, when you talk about COVID-19 and insurability and all that type of stuff, these questions ring true even more now than ever.
Wow. Okay. So let's go ahead and get this ball rolling. Question number 1. Why do I need insurance if I have it on my job?
Oh, people, look. This is a question that I get a lot now, and it's crazy. The reason why I get it a lot now is because, this is the first time in American history where there's more people that have insurance only at their job than outside their job. There's 111 million people or so that have insurance on their job. There's only 108 million people that have insurance outside of their job. There's another 100 million that don't have life insurance at all. So the reason why you need to have insurance outside of the job, number one, is because you own it, right? It's your policy. It's not owned by the job. And I know that we're going to have our best interests in mind over the company. Okay.
So basically, if I get fired from my job today,
absolutely,
then I still have my policy.
Right. When you have your own policy, it's something that you have. But if you lose the job, you lose the insurance. Another key point with the reason why you need to have insurance at the job is because most times it's just not enough. It's just not enough. Most jobs are doing 2, maybe 3 times in some cases your salary. Mm-hmm. Well, if you factor in everything that you have at home, you have a spouse, you have kids, you have a house, you have debt. A lot of times that insurance is not enough based on what you make. Okay, because we can go through the numbers of what the average person makes at their job. If you multiply what you make times 3 and think about all your bills, what you got left behind, if it's enough. Right?
So you're saying for the long term, that's what we need to be thinking about.
Absolutely.
Instead of just, hey, I need some money for burial.
You're right.
You gotta be thinking about your family and your
well
kids.
Beyond that, because you got people left behind. Another problem with job insurance is that, just like most benefits, if you ever go on disability, right, your pay reduces if you go on disability. Right. Some other benefits they either reduce. Well, your life insurance actually will, in most cases, stop. So imagine if you got diagnosed with COVID-19. Since that's the current topic. You get diagnosed with COVID-19 and God forbid you die. Well, wow. You died on disability. Well, even though you were still employed, you were on disability. That means with your insurance, it's not active because you're not actively working. So that insurance won't pay out. So you need to have insurance that you own so you don't have any of these questions when it comes to your own insurance.
So if I have life insurance and let's say I happen to pass due to coronavirus, I am already good.
Yes.
Have you had any situations where people have been more active about life insurance
right now
with the coronavirus?
Oh, absolutely. Because the thing is this: no insurance company will insure you if you are diagnosed with COVID-19. You can forget about it. I even saw today where if you were diagnosed with it, that the military is not taking you.
Wow.
Yeah, I just saw that today. So that's just let you know. Look, if the military is not going to take you. If you get COVID-19, you're uninsurable.
Wow. I take this personally, because my clientele is heavy military personnel, and a lot of my guys are transitioning out of the military, and they call and ask for coaching and things like that. So, usually when we talk to them about policies, they say, "Oh, I got it through the military already. Me and my family are good." What is something that you think that they don't know in regards to their policy?
Well, the thing that most people don't know is that when your active service is very inexpensive. It really is, okay? And you can get a lot of it. The problem is that it only covers you, the individual that's enrolled. Okay, so it's not covering the spouse, it's not covering the kids. Okay. Another problem is when you leave, the cost goes up significantly. All right, and then you're only able to get what's called a 5-year renewable term, which means at the end of each 5 years, you have to go and renew your policy. Well, in renewing your policy, you have to prove that you're insurable, which means, are you healthy enough, right? So you can imagine, again, we're going to use current topic, COVID-19. You left the military, you get diagnosed with COVID-19. Well, you can't get insurance if let's say it's time for you to renew your policy. At the end of that 5 years, you get diagnosed with COVID-19. You can't get insurance because now you've been diagnosed. Wow. So you need to make sure, outside the military, you have your own, because again, nobody's going to take care of you and your family like you are going to take care of you and your family. So own your own policy.
And one of the things that strikes me, we typically don't think about this, but like you said, the military covers you. It's not covering your family in case something happens to them. So even if you are insured, you may still need to get one on your wife and on your kids. We're not wishing anything bad on them, but life does happen. And one thing about it, you don't want to be in one of those situations.
Absolutely.
So moving right along to question 2. How much insurance do I really need?
I love this question. Okay, so people, you need to get enough insurance that's going to take care of your family for a period of years. So this whole notion about getting just enough to bury, I mean, honestly, in my opinion, and this is my opinion, that is that's a short-sighted way of looking at things. Especially when you have kids, if you have a spouse, all the things that you acquired together, if it's not paid off, it still needs to be paid off.
Right.
You still have things that you need to take care of. So we use an acronym called DIME. It's to kind of determine how much insurance you need. Now, the industry standard says you should get 8 to 10 times your income. Right? So DIME stands for debt, income, mortgage, education. How much debt do I have that needs to be paid off? How much income do I need to replace and for how long? And then do I have a mortgage? And do I want to provide educational for my kids? Okay, do I want to pay for that? Okay. So in determining that, that's going to tell you, usually that number is going to fit somewhere between 8 to 10 times what you make. The number kind of magically figures out that way.
Right.
But you want to have enough that you are able to not only take care of yourself, but look, the truth of the matter is there's been much wealth that has been built through insurance. When you get an insurance policy, it instantly, that's the quickest way to create an estate. It's the immediate. Yes. It's the only way to immediately create an estate. Is through a life insurance policy. So there's plenty of people there who are business leaders who have built their empire through the insurance that they got from a loved one. And we got to think on that level. It's called generational wealth, generational wealth. And so to change the dynamic, you need to get enough that's going to make sense to pay for your family. And everybody's situation is a little different. Right. You might only have one kid. It might be grown. Right. You might have your house paid off. So just looking at that dime, though, kind of lets us know, well, if something happens, I know this is going to be taken care of. My family's going to be good.
Let me ask you another question that I think people typically have. When you said debt, that hit a nerve with me. If they have debt, or if the person that passed has debt, how does that affect their insurance if they don't have enough?
Well, depending on what type of debt it is, obviously, if you have a car and you and your spouse were paying, you got 2 cars and you were paying on them, you want to keep them. Well, if his or her income is used to make sure that everything is sustained, well, what happens when that other income is not coming in? Right. You can lose credit card debt doesn't die.
It sure don't.
Student loan debt doesn't die.
It sure does not.
It's the only debt. Student loan debt is the only debt you can't die out of. Right. So you got to think. Okay, well, if that's left behind, I'm going to be saddled with that. Right. You know what I mean? And so you just want to put yourself in the best financial position for you and your loved one.
Right. Moving right along to question number 3. Do I have to wait 2 years before any benefits will be paid out?
I get this question a lot simply because a lot of people that know a little bit about insurance, they heard about this 2-year thing. What is this 2-year thing? And all industry state regulations have what's called a 2-year contestability period. Okay. So it's not specific to an insurance company. It's a state regulated deal. All that 2 years means is that, well, first of all, no, you don't have to wait 2 years before the proceeds are paid out. But that 2-year window is what's called the contestability period. Okay. During that time, the insurance company can contest if someone dies by suspicious means. Right. So you get a policy today, you die tomorrow, and it's like, okay, well, we have to investigate. Right. Okay. And so that 2-year window is what allows the insurance company to figure out if everything was legit.
So you're saying if there was no fishy business,
right,
there's still a timetable as far as how do I get the money or how fast I get that money to my family if something happens to me.
You mean if within the 2 years?
Right. Like I passed today. And I know the answer to this question because I deal with it all the time, but for the viewers, if I passed today, there was no fishy business, natural causes, car crash, whatever the case may be, how long will it take for the policy to be paid?
Yeah, and that's relative to the company. I know our company pays typically 95% of our death claims are paid within 2 weeks. 95%. Some, which dictates what quality of the company you have. But generally, there's some other factors that go into it, depending on how fast you get it. If it is something, even if it wasn't a suspicious way, but you got shot, right? Yeah. There still has to be investigation. You have to wait for the death certificate. In a lot of cases, you got to wait for the autopsy.
Right.
So toxicology report and all that kind of stuff, because it's just the nature of it. So now with that, what happens is if your policy is proven valid, you go to the funeral home and you do what's called, you sign an assignment, okay? Which means they're going to, based on the fact that that policy is actually valid and they know it's going to pay out, it'll pay enough for the funeral. And then when everything, they'll hold that amount in there from your proceeds. They'll just go ahead and do it. And then when the policy is paid out, you get the difference and do it like that. But if it's a valid policy, no, you don't have to wait 2 years for it. And like I said, there's some other little mitigating factors like that, but other than that,
it's gonna take care of you.
It's gonna take care of you. Yes. All right. Yep.
So moving right along to question number 4: can I save or get money from my policy?
Yes. Okay. Get this.
I know this is a big one.
It's a big one. Okay. So we're gonna try to make sure we do this as simply as possible. So there's first of all, there's 2 types of policies, life insurance policies. There is cash value, and there's which is a policy that allows you to have insurance and cash savings. Okay. Then there's term insurance, which is just pure, straight up insurance. It operates just like car, health, or home insurance. No savings attached to it whatsoever. Now, there's various opinions between the two, but I'm just showing you. I'm all about numbers. Okay. So cash value, there's 4 different types of cash value. There's whole life, there's universal life, variable life, and then there's index universal life. So all those policies, you can actually accumulate a cash savings in those policies with stipulations. Okay. Term insurance, like I said, no insurance. There's no cash savings in there whatsoever. So yes, you can get money out of a policy, but there's very heavy stipulation that you need to understand when it comes to getting those policies. There's 4 things in particular, okay, that you need to be aware of. Number 1, cash value insurance policies have a delayed savings. What that means is for the first typically 2 to 15 years, there's no accumulation of savings going to be in that policy, depending on what company you're with, what policy you have.
So let's slow that down for the viewers and let's talk about that. I'll give you an example. My grandfather, before he passed, he fell in the store. He fell in Minions. That's how you know it's been a minute ago. And he was going through a litigation process, and he wanted to take money out of his whole life in order to pay for lawyer fees or something like that. How would that work? Like if he had, so what you're saying is if he hasn't had his policy long enough or accumulated that value over a period of time, there is nothing that he can go in there and get.
Imagine if you were putting $100 in the bank every month. 5 years, you go down to make a withdrawal because you have an incident like what your grandfather had. But you get down to the bank. Now, for 5 years, you're putting $100 in them every month. Right. You get down to the bank and they say, "I'm sorry, Mr. Tenison, but there's no money in this account." Well, that's the same thing with a life insurance, a whole life policy in that regard, cash value insurance. So for the first 2, it can go as far as 15 years. I've had a client, the longest I've ever had was I had a client that had one for 10 years before the cash value accumulated. But there's 0 accumulation during that time. When the accumulation starts, it'd be whatever year that your policy indicates, but even then, it's still not significant enough amount for you to be able to withdraw anything that's going to make any difference.
Right. Okay? And another thing that to kind of piggyback off of what you're saying is, imagine if you were having your money in the bank and you take your money out of the bank. When you pay this money back into this whole life policy, you're paying interest on your own money.
That's my third point. Exactly. So the second thing is that it pays a very poor interest rate. Okay, so these 4 points of cash value. Number one, delayed savings. Number two, it pays a very low interest rate, average about 1.8%. You can find some between 2, 3, maybe 4 in some cases on some higher end universal or IULs,
which isn't even keeping up with inflation.
It's not even keeping up with inflation. Now, the significance of that, let me put that in perspective. We teach something called the Rule of 72. Okay, Rule of 72.
I want you to slow down when you explain this.
Okay, so the Rule of 72 is a very simple calculation created by Ben Franklin. That tells you basically how fast it's going to take your money to double. So basically, how fast it's going to take a $1 to turn to $2. It's so simple, a fifth grader can do it. You take whatever interest rate you're earning and just divide that number into 72. Well, the answer you get is the number of years it's going to take for your money to double. So imagine this: if you're only saving it, if you're on your interest that you're getting is only 1.8%, which is typical on whole life or cash value policies, well, 72 divided by 1.8 is 40. So it would take 40 years for $1 to turn to $2. Mind you, it took 2 to 15 years to get $1. And when you finally get $1, it's going to take another 40 years for that dollar to turn to $2. The third thing is that you can get the money out of the policy if you have an accumulation, but you got to borrow it. Okay, you got to borrow the money out of the policy. Well, now if you borrow something, it means you got to pay it back, right? Okay, so the average interest rate you have to pay it back is at 8%. 8%. Okay, and so the last thing is this: let's say you have some cash in there and you haven't touched it and you haven't died yet or anything like that. You got $50,000 policy, you got $10,000 cash. You want to get that money out, you can get it. Okay, you can get every dime of it. Let's say you never borrowed it, but right now you got an emergency. Your grandfather, right? You can take that $10,000 out, but if you take the whole 10 out, you cancel the policy. It's called a cash surrender. You lose the entire policy. Okay,
and that's called a cash surrender.
Cash surrender. Okay, you might say, "Oh, well, I don't want that to happen, but I do need to get some of this money out. I got to take care of these lawyers. Well, I ain't gonna take the whole 10. Let me get 8. Okay, you can borrow the 8, pay it back at 8% average. Okay, but if you die before you paid it back, whatever you borrowed times the interest, they're gonna take it out of the policy.
Right. And so basically, if I made if I've been paying $20,000 into my policy up until this point, and I have a $100,000 policy, what you're saying is that if whatever I took out, if I took that $10,000 out, then I'm not gonna get the 90,000 if I pass, or the 100,000 if I pass. I'm gonna get 90 or less, or right at 90.
90 or less. It depends on how long it took for you to pay back the loan. If you hadn't paid back the loan at all, whatever you borrow times the interest, they're gonna take that amount. So I've had clients that had $10,000 policies. The family, somebody died, and the family thought they were getting $10,000 worth of insurance. Well, it ended up being like $5,000 because the person borrowed money from the policy, but didn't pay it back in a timely manner, so all that interest accrued.
Right, and one thing I can tell you, even if you're trying to take a lowball funeral and you're trying to be bare minimum, $5,000 is not a lot of money for a funeral.
No, it's not. It's not. Absolutely not. I mean, you're going to be struggling. And so the thing about cash value insurance is that you pay for two things, but in the end you only get one.
Right.
Okay.
Last but not least, this is a good question right here. How much is life insurance, and what factors into the cost?
Get this question a lot. People asking, well, how much is life insurance? Like, it's a general question, like you're going to the store to buy some chips or something. No, it's not like that. Okay, it's based on insurance is based on two factors. It's based on age and health. Okay, how insurable are you in particular when it comes to your health? If you had some issues health wise, there's only two things that are going to happen. You either going to get denied altogether, or if your health is bad, but it's not something that'll prevent you, you'll be rated higher. So it's called rating a policy. So there's three standard rates in insurance. There's substandard, there's standard, and then there's preferred. Well, there's few people that can get the preferred. That means you're in tip-top shape. I mean, you're not taking any medicines or anything like that. You don't smoke or none of that kind of stuff. That's preferred, right? You like a marathon runner or something. And then you got the standard, pretty much where most people fit. And then you got your substandard that can get insured. But again, if your health is in a position where you're a higher risk, you're going to be rated higher. So those are the things that factor into the cost of insurance.
So let me give you an example. I have a client that came in and they said, hey, look, I want to have a life insurance policy, but I'm a cancer survivor, and it's been, 2 or 3 years since they survived. I'm glad that they survive, but they're trying to get a life insurance policy, and they're saying right now that they can't.
Right.
So what's up with that? Like,
well, yeah, and that's you. And little is actually you actually can get insurance if you've had cancer and you're a survivor and it's been in remission, but it has to be in remission at least 5 years. Typically, is what most insurance companies is going to do is say if it's been in remission for 5 years, that we can get you covered. You might get rated higher if there's any kind of lingering issues that aren't necessarily directly related to the cancer, but it caused something other thing to happen or something like that. But typically, that's what happens. But different factors. I mean, people with diabetes can get insurance.
Right.
All right. If you're not insulin dependent.
Right.
If you're on a pill or handling it with diet, you can get insurance, but you're going to be rated higher because now you have a higher risk of mortality. Yeah, you have a higher risk of mortality.
Right. So one thing I wanted to go back to was that you spoke about whole life average being, between 1.8 and 4% ROI, return on investment. What is the return on investment for term?
Okay, so term insurance, term insurance is straight insurance. It's the purest form of insurance that you can get. There is no cash savings. So what people say is, well, why would I get a term insurance? I can't get any money return on it or anything like that. Well, what you do is you get a low cost term, because term insurance itself is very inexpensive. Okay, so one thing we advocate is buy term and invest the difference. So if you were going to spend $100 a month on a life insurance policy that was cash value, but you can get twice the amount of coverage for half that amount, say $50. Well, we say we take that other $50 and we start you an IRA with it. Okay, so now you got your money and your insurance going at the same time. So if something happens, well, you still have a significant amount of money through your insurance, and you still have some savings that are growing too as well. But the good thing about that is the person doesn't have to choose which one they get, as what happens in cash value. Your family gets both.
And the good thing that I like about term is what you saying, invest the rest, is because if you're financially fit and you are putting that money into your IRA, and your IRA is compounding interest and things like that, after a while, once that term is up, you may not need term insurance because you have enough money to where you can self-fund and still be able to take care of your family.
We call that the theory of decreasing responsibility. Okay, so over a period of time, in the beginning, you need a lot of insurance because you got kids, spouse, mortgage, debt, blah blah blah. All that stuff happens. Something happens to you, and no insurance in place. I mean, everything crumbles. Well, as time goes on, things change with time, and those same kids, they get grown and gone. Okay, grown and gone. Right? Your kids are grown and gone, and your debt's low, and your mortgage is paid off. Now, what you want to have is retirement income. You want to have some money, because you can't take a life insurance policy down to the grocery store. You can't pay your light bills. Well, you need to have some cash. So what we say is, okay, well, during that time we have your insurance in place, we're going to show you how to invest and save properly. You get to this point of retirement. If you got $1 million accumulated, why do I need to spend $100, $200 a month on insurance when I got this money accumulated? Exactly. And so, and it really boils down to education. When we talk about getting term insurance, we say, look, we got to get your money saved. We got to do that, because that in line goes with everything that's going to make this whole thing make sense.
Exactly. Now, one more thing I wanted to touch on before we had to get up out of here. We've answered the 5 questions. When it comes to children, I want you to tell the listeners why it's important for you to get policies on your children at an earlier age.
Okay, so I'm going to tell you something. Out of the last 5 death claims I've paid, 3 have been on children.
Wow.
Okay. One of been one of my best friends. He lost his son. I had a friend from high school. She lost her baby. And then I just recently got a call a week and a half ago from a client of mine. Her 17-year-old niece died. And so they found her. And so, it's important to get coverage on kids. Number one, because it's cheaper when they're younger. Okay. Right. But number 2, life happens to everybody. Nobody leaves this world living, and there's no time that you come into this earth when you know when you're going to go.
Right.
So we all lose people at different ages and stages. And so why not make sure that while you go through one of the most emotionally challenging times in your life, that you wouldn't have your kids covered? It's not about coming up. It's about making sure you can get through.
Right.
You know what I'm saying? Because when you lose a child, you got to pay for it. And who says that you want to go right back to work? Right. You want to be able to kind of collect your thoughts and be able to grieve.
Right.
And without having to worry about how am I going to pay my bills.
Exactly.
And so, that's why it makes sense to get insurance on kids.
Man, hey, I heard you say something the other day and it kind of stuck with me. Nobody really wants to talk about life insurance. I'm in the barbershops all of the time. Well, not right now during Corona, but, I've actually heard people in my community that will say, fathers in particular, like, hey, I didn't start out with anything. I worked for everything that I had. My kids need to work and earn everything that they have or that they're going to get in the near future. I don't know, man. My biggest thing is, how important is your family to you? You know what I'm saying?
Again, I go back to it, and I don't mind saying it. I just think that's a selfish way of thinking, because for communities that have built wealth, you think about some of the greats and some of the people who are not so great but still up and doing their thing.
Right.
They were funded by their family. And so, a lot of times we don't have the financial backing to be able to say what we built, we can leave that behind, for our kids to take advantage of it and keep the ball running forward. Well, one way we can do that until we get to that point financially is get a policy that's big enough to make sure that if, let's say, your son or daughter wants to start a company where you got enough money. I mean, Master P said it, his dad.
Man, that's my example.
His grandfather gave him a $10,000 life insurance policy. It wasn't a lot of money, but even back then.
In the 90s.
It was enough for him to start his record label.
Right.
You know what I'm saying? Now look what he's done for his family moving forward.
Exactly.
His kids never have to worry about anything. And it's about generational wealth, y'all.
It's
about generational wealth. Different communities, different people do it all the time. Why wouldn't we do it?
Exactly.
It just makes sense, to put your kids ahead of the game. That's just like saying, okay, I struggle to pay all this student loan debt, so I'm gonna make my kids do the same thing.
They'll be all right.
Yeah, they'll be all right. You know what I'm saying? Whatever, man. Say, get a college fund going so your kids can start ahead of the game.
Right.
How great would it have been if you were able to start your life, your grown life, without having $100,000 in debt? How much further ahead of the game could you be? And so the same thing is, you got to look at that with the life insurance policy. So,
hey, man, you said a word today. Hopefully we've answered these 5 questions. I'll say it like this. You don't know what you don't know. We're going to be providing more information about financial literacy. We're going to, have some of everybody in here. But, the keynote speaker today, Mr. Ashanti Wade, has said his word, and we appreciate him for coming in. Tell these people, tell the listeners and viewers where they can reach you at.
Real simply, I'm on all the major social network platforms. So obviously Facebook, Instagram. My son's trying to get me on the Snapchat, but I don't, all that type of stuff. But anyway, outside of those ways, the most conventional way is phone number is 469-236-6003. You can reach me at my email at anwade08@yahoo.com. And we do, and in the midst of the coronavirus, we've been doing something that has actually helped a lot of people. And we're doing Zoom appointments. So you can reach out to me, inbox me on Facebook, or Instagram. Just let me know, schedule a Zoom appointment with you, and we can go through all the things, answer all the questions you might have. Technology has been a great deal, and so we're using it to the best of our advantage.
Hey, man, we appreciate you coming through. Just JCC in the
Yes,
building,
sir.
man.
Yes, sir.
Once again, we thank you for watching and tuning in. We'll be giving you more information. Tenison Financial Group, we are out.
Out.